Happy Friday, Eric Bible with the Bible team at Neo Home Loans. And yes, it's a happy Friday as it was an action packed week. Tons and tons of market moving data. And yes, mortgage interest rates benefited from the chaos. I'm happy to report that this morning the 30-year fix kicks off at 6.98%. Yes, you heard me correct. 30-year fix with a 6 in front of it. Yes, it's a high 6, but a 6 nonetheless. So we can now comfortably say rates are back in the 6s, down from last week's 703, and we're going to take it. So let's understand what drove the movement this week and why it finally appears that, hey, inflation's behind us. The Fed's a little angry, but it does appear that things are shifting. Yes, I know I've said this before. We've all heard it before, but there is a lot of telltale signs in the data that was received this week that a turning point is likely in front of us. So let's get into it. First and foremost, Wednesday. Wednesday was the most action-packed day as we not only got consumer price index report for the month of May, we got Fed rate decision. So first and foremost, CPI. Ton of anxiety walking into this report, as we've seen in other CPI inflation reports throughout this year. It's been misses and misses not in our favor. Well, this week, the miss was finally in our favor on both the core and the headline. We showed prices, so the cost of goods accelerating on a month-over-month basis, come in below expectations. We saw the core rate of inflation come in at 3.4%. And the headline number come in at 3.3. Yes, we're still off that 2% target. And yes, the Fed spoke of this, which I'll get to here in a second, but a meaningful decline. And it's coming on the back of, cost of goods, especially gasoline, motor vehicle insurance, shelter, groceries, the list goes on, that have rapidly risen in short periods of time. But to be able to see this type of pullback provides a tremendous amount of hope that, hey, inflation going forward should start to come down at a more participitious rate. I don't think that was a word, but you get what I'm saying. The next key component on Wednesday, Fed rate decision. Now, there was no denying walking into this meeting, the expectation was rates were going to remain as is. No cut, no hike, steady course. As expected, that's what was delivered. Fed funds rate did not change. However, what did change was the all-important dot plot. Now, I've spoken of the dot plot in the past. Essentially what it is, every 3 months, the Fed's voting members of the Federal Reserve get into a room and unanimously telegraph where they expect to see not only the short-term, but the long-term Fed funds rate. Well, at the beginning of the year, the expectation for 2024 was 3 rate cuts. That was revised at this past meeting. And that's what kind of diverted some of the rally experience from the CPI numbers later that day, meaning interest rates got marginally worse compared to marginally better. Instead of 3 rate cuts, they're now expecting 1 rate cut in 2024. Now, we don't know when, only the Fed knows, but that was tailed back. Key things, though, that Jerome Powell did say, yes, inflation is still here. They're not at their 2% target. So they will maintain rates at this restrictive level until they start to see data like they saw on Wednesday on a more consistent basis. The other key aspect, labor. Labor market has been incredibly robust, as I've shared in weeks past. Whether you agree with the numbers or not, unemployment is sitting at 3.9%, and new jobs are being created month after month. Jerome Powell spoke to that. If we start to see unemployment rise, we're at currently 3.9. If it goes over their projections of 4.1%, becomes a completely different game. So definitely things that we will be watching, and I know the market will as well. So that brings us to information received on Thursday. And that's really what extended the rally into this morning. And that's what we're running into the weekend with. So first and foremost, producer prices, all important PPI numbers. This is what the wholesaler pays, which in turn delivers to the consumer. Another surprise in our favor. We actually saw a negative number on the month over month reading, negative 0.2 to be exact, followed by a decline on the year over year number, which extended the rally started on Wednesday. Additionally, initial jobless claims saw a unexpected rise as well. 242,000 new applicants filing for unemployment for the first time, which again is a clear sign that the labor market may not be as strong as once perceived. And this is something also that Jerome Powell spoke to in his press conference as well, as it's appearing that if we continue to see reports like this on a week over week basis, where new individuals going into seeking unemployment benefits could be a very rapid change, coupled with the BLS jobs report, which again we'll be getting again in July. That said, this was a very, very important week. And the importance came down to mortgage interest rates benefited. And again, it's starting to appear that we have truly turned a corner where higher rates are behind us. Now, obviously, don't shoot the messenger. Hey, my crystal ball is definitely broken. But given the data that was received today, a lot of the leading indicators into it is that it does look like we're going to start seeing some more favorable prints, which will ultimately drive rates down. As I said last week, this is now yet again another opportunity for you to get on the horn with your clients and telegraph that real estate is yet again on discount. If you need help telegraphing this message, know that we're here to support you. As always, make it a fantastic Friday and an even greater weekend. Thank you.